We are excited to get started today and discuss some of the investing and planning myths and whether or not they are accurate or if they can be busted. Joining me today, of course, is fellow financial advisor Grant Moore, and I am Jake Lesher. Welcome, Grant.
Good to be here.
Well, the first myth we'd really like to dive into, we're going to start with a series of investment-related myths, and then towards the end of the presentation, flip over to planning-related myths, more on the financial planning side of things. And the first myth we'd like to dive into a little bit is whether cash is always a safe investment. Well, like with anything, really depends on what your definition of safe is. Are you seeking low risk or low volatility? How does longevity factor in your decision to hold cash over a long period of time? So a few things to point out on this slide. First, this is a long time horizon, going back way before the Great Depression. Second, all of these lines outline different investment returns, and of course, the ones that obviously have risk, all would be considered safe by some definition. Now, we would define safety based on someone's time horizon and, frankly, their overall cash flow needs from investments. For example, if you focus your attention on the green line, treasury bills, otherwise known in this case as cash, cash would have been safe and considered a haven during the Great Depression and until the 1940s, which was nearly 15 years where stocks produced almost no return, and cash was actually an equally good performer. It had low volatility, and other than the run on banks during the Great Depression, may have provided some comfort during this period of time. Now, most of the time, people have a longer time horizon than 15 years, and most of the time, stocks and bonds produce better returns than just holding cash in 10 to 15 years. Now, this chart, puts safety of cash in a real-life perspective over a 30-year time frame, which in this case could be a common retirement. Illustrated here is an individual starting with a $1 million investment portfolio right before the tech boom of the 1990s. And someone that chose to take out about 5% of their investments each year, or about $50,000 for living expenses. Now, this person also increased their withdrawals slightly for the cost of living each year as an inflation adjustment. Now, with the benefit of hindsight here, we see that simply leaving funds in the bank, and while it may have felt safe early on, actually becomes less and less safe as time moves forward. The real risk for most people in retirement, of course, is running out of money. We perceive volatility in stock prices as true risk, but volatility really is the price that we pay to earn long-term returns. So if you can weather the storm, you can see that even in the very worst period, after a 60% stock decline during March of 2009, a diversified portfolio of stocks or stocks and bonds left this investor with more money than otherwise holding funds in cash where it felt more comfortable. So as you can really see, cash really isn't always just a safe investment. It really depends so much more on someone's time horizon, of course, risk tolerance as well, and then of course the need for cash flow from an investment portfolio. Now, the second myth we'd like to review is the one where someone would consider only investing in US blue chip stocks as that being a good strategy. Now, blue chip stocks are, of course, the largest 500 companies in the United States, commonly known as the S&P 500. Now, of course, as you'll get the hang of this as we go forward, the way we lay these out might remind you of those true-false questions from the days back in school. Anytime someone uses an absolute like only, the answer is incorrect. But let's dive into the details here. Now, this chart has a lot going on, and it's quite busy, but I'd like to simplify it a little bit. On the left-hand side and on the top of the chart, you will notice different calendar years. Additionally, the figures contained within the chart, either highlighted green or left white alone, represent the additional return gained or lost by investing in global stocks or just US large companies. For example, on the left-hand side, if we pick 1973 on the top column as our beginning date, and then select 2020 as the bottom row as the ending point on the left-hand side, you will see that global stocks have produced about 1.5% per year return more than just owning US large companies only. However, of course, it's interesting to note that there are also two large sections of white in this grid during the 1990s and the most recent 10 years. These were times when it was better to own only US large companies. Now, in total, and to summarize, anytime green is highlighted, it represents a period when all global stocks perform better. And as the box indicates on the right-hand side, almost 76% of the time, global stocks are better historically. Now, given our recent run in US stocks, even with the benefit of history, does that always ring true? And what would that impact look like both on a cumulative and a long-term basis with real dollars, even though the data, of course, points to being global stocks better than just owning only US large? This chart outlines the growth of just a dollar dating back to that same common date of January 1st of 1973, and again, continuing through December of 2020. Now, if we carry forward that same global stock and US large conversation from the previous slide, just a dollar actually created nearly double the dollar return in global stocks compared to US large only. And more interestingly, did so with less risk. So the box in the middle of the screen outlines risk, our measure of standard deviation. Now, while our perception of owning international stocks or emerging markets might be more risky, when they are owned in combination with US large stocks and other US based investments, your risk actually goes down. So it's almost like having your cake and eating it too, right? Having more return and less overall risk. But clearly, I think as we've pointed out here, having only US based and especially US large based companies isn't always the best strategy, and certainly being more of a globally diversified investor makes sense over long periods of time, even if it's frustrating. The next myth we'd like to kind of point out is whether or not gold is a good investment. Now, there's been lots of discussion about this over the years. There's been certain time periods where gold certainly is more in vogue. But it begs the question of whether it's a good investment or if it's something that's a better collectible or an heirloom, frankly, something that should be treasured and worn rather than owned as an investment long term. Now, similar to our conversation regarding cash, comes back to how you define good as an investment. Is good considered something safe, perhaps low volatility? As you can tell with this chart, you can see that compared to stocks and even a basic stock bond portfolio, gold has produced substantially less return over the last 40 years. Gold's actually appreciated at nearly 5% per year during this period, which isn't bad, but inflation has certainly been much higher over this period as well, compared to longer term averages going back to 1926. Comparatively, the stock bond mix produced closer to 10% per year, and all stocks more like 13% per year. So quite a staggering difference in wealth accumulation on just a $1,000 investment. Now, over these long illustrated periods, gold obviously isn't a good relative investment, especially for large accumulation of wealth. But in shorter periods, individuals sometimes consider buying gold as that safe haven or to protect against inflation. Now, while that's not a bad application of owning gold, there are several downsides to consider. Number one, gold doesn't pay dividends like other normalized investments like stocks and bonds. Number two, you need to consider where you put your gold. Have it in a safety deposit box, perhaps a shoebox in the closet, or other type of safe place. Three, you actually often pay a premium price to purchase, an actual premium cost, which is essentially like a large commission to whichever agent sold it. And four, if you do actually experience a gain, which is the goal, of course, of long-term growth, interestingly enough, and something that isn't often pointed out, the tax rate on gold and other collectibles is actually nearly double normal capital gain rates. 28% is the tax rate on appreciated gold, whereas the most normal capital gain rate for stocks is 15%. So, in summary, gold or other precious metals and commodities may have a role in your portfolio, but consider these points and review with your advisor. Now, I'd like to pass the presentation to Grant to review the next three common investing myths.
Thank you, Jake. The fourth myth that we want to discuss is that market timing adds value to a portfolio. Just to give you an idea, market timing is the concept of being able to buy an investment while it's low, sell it while it's high, and not really ride the waves that the stock market oftentimes presents. This graph looks at a 30-year time horizon, and it compares the S&P 500 with just a buy and hold strategy as compared to a market timing strategy. You can see over that 30-year time horizon, while it wasn't smooth, the buy and hold strategy resulted in an average compounded rate of return of 10.5%. By comparison, the market timing strategy was an 8.1% rate of return. The way that we modeled this was the idea that some investors look at stop losses. So in other words, if an investment falls a certain percent, they automatically sell out of that investment, wait until it hits some sort of bottom, and then get back in. For the sake of this illustration, once the market went down 5%, the investment was automatically sold. It was then waited until the bottom hit, and then there's a 3% increase or recovery off that bottom, which is when someone purchased, assuming that they had basically hit that bottom and they were wanting to participate in the upside. You can see that the difference of about 2.4% resulted in about half the long-term growth, not percentage-wise, but dollar-wise. $10,000 in 1990, growing to $103,000 in 2020, as compared to $200,000 of just a buy and hold strategy. In addition to this, the $103,000 is a pure percent return, so it does not take into account the fact that during those 55 purchases and sales, there would have been transaction costs and taxes, which ultimately would have brought that number down a bit as well. The other thought here is that markets really are unpredictable. Many of you have probably seen some variation of this chart. It looks like the periodic table. On the left-hand side, you can see the different asset classes that are listed with a color representation. On the top half or so are stock asset classes. In the middle are bonds, and then the last four are more of the alternative investments. If we look year by year, we then rank those from the best performing asset class down to the worst performing asset class. And what you can see from this chart is if we look over the last 15 years, there really is not any discernible pattern. So what has done well for a year or two, oftentimes then falls and becomes one of the lower performing asset classes. Similarly, what has done poorly for a while can then have some really nice returns. So this really shows that it is very difficult, if not impossible, to predict what markets are going to do, certainly over a long period of time. The fifth myth is that active stock picking can protect me in a down market. So in other words, if I can't accurately get in and out of the stock market to lock in returns, maybe I can just pick the winning stocks and kind of avoid the losing stocks and enhance my return that way. However, the research shows that stock picking really does not work. So when we look over a 15-year window, finishing at the end of 2020, whether it's large US companies, small US companies, international stocks, or emerging markets companies, the professional money managers, all the average funds fail to beat just the benchmark. So the S&P 500, the large US company stocks, the index itself produced a 9.9% annualized rate of return, whereas the average of all the professional money managers produced an 8.2% rate of return for large cap stocks. The discrepancy was even larger for US small company stocks. There was a 2% advantage to simply buying the index. The international developed markets, it was about a 0.3% advantage for the index as compared to the mutual fund average, with a little bit larger in the emerging markets, about a 0.8% advantage, again, to the index. The sixth myth then is, well, I should just buy funds with winning records. I'll pick the actively managed portfolios or fund managers that have a proven track record, and that is a way that I can get more return than the actual index or the market produces. However, in practice, that is very difficult to have actually take place. So again, the year ending 2020, if we look at the previous 10 years, we started with 3,082 stock funds in the whole universe of stock and funds out there. 37% of those failed to even be in existence 10 years later. So 63% survived, but only 23% were quote unquote winners. In other words, they beat the benchmark. The benchmark is really that fund's job description to at least match or exceed in terms of the return. Again, over a 10-year period of time, only 23% of funds were able to do so. If we look longer term at a 15-year window, roughly half of the stock funds out there failed to even be in existence 15 years later, and only 20%, or 1 in 5, beat their benchmark. And the same math applies for 20 years. Only 19% were winners as compared to the benchmark, where only 41% of the funds even survived that 20-year window. So now I'll hand it back to Jake as we enter more of the financial planning pieces and shift away from some of the investment options.
Yeah, thanks, Grant. And as I was just thinking about the previous slide as well, we've all read and heard the investment disclosure that past performance is not indicative of future results. It couldn't be more apparent, at least with those last several myths. It becomes very difficult to pick the best next active fund manager, especially when, almost like throwing darts at a dartboard, right? Now, the topic of healthcare expenses, and in particular long-term care, is a topic we often discuss with clients. There was a time when it seemed like everyone should consider buying long-term care insurance of some type, whether it was to help protect a nest egg or maybe to align with other legacy goals. But it often begs the question, is this the case even now or moving forward? Well, let's review the facts a bit. While it's true that most individuals over the age of 65 will need some type of care, it doesn't mean that 100% that this care will involve the 24-hour per day, 7-day a week nursing care that we all fear. The statistics actually tell us that the vast majority of individuals will be able to gain some level of help in their home, whether it's Meals on Wheels or live-in RNs or CNAs to help with bathing and dressing or other daily activities. Of actually the 2 of 3 that need care over age 65, only 20% of that group is actually statistically required around the clock and the most expensive form of longer term care. I think the largest fear most people have, and one we discuss pretty often, is how long someone might need this care. We've all been impacted by close friends, relatives, loved ones who unfortunately have experienced dementia or of some kind of severity. When this happens and the person is still very physically healthy, that can obviously fall outside that trend. Usually, however, only about 1 in 5 that require nursing care will need the more than 5 years of support in those higher cost facilities. So the point being, of course, the majority of individuals still don't fall on the severe end. But sometimes, of course, the fear of this experience, particularly after seeing a loved one or a family member go through it, will make us consider if purchasing long-term care actually makes sense. So first, why might you not need to purchase long-term care insurance? Well, perhaps you have, a large asset base and you've maybe completed statistical financial planning models to help you determine your ability to self-insure your own costs in the future. If you have modest expense needs normally, or you have accumulated more than you need to meet your lifestyle goals, it's possible you will have extra fuel in the tank to pay for more of those expensive care needs in the future without a substantial risk of ever running out of money. Other times, quite frankly, long-term care is just expensive. At one point during the 1990s, there were actually more than 100 insurance companies that sold some level of long-term care insurance to customers. However, they didn't have the actuarial science, like with life insurance, fully vetted to understand proper pricing. And that led to a very large demand early on from insurance companies. One, to purchase it because it was very cheap to buy, and 2, to actually have the benefits paid out. And because of that, insurance companies having not priced it well enough, lots of insurance companies have actually stopped either issuing new policies or gotten out of the business altogether because they've lost money. Now, of course, long-term care insurance you can buy comes from fewer companies, typically costs a lot more to actually buy. And the pure long-term care insurance where you pay a premium and receive a benefit isn't nearly as popular as the other routes of utilizing either a life insurance vehicle or, frankly, an annuity vehicle of some kind to acquire it. Now, all that being said, why would you consider purchasing long-term care? Number one, of course, peace of mind. You really can't put a price on peace of mind, as we all know. If you can afford it, within your normal budget, and it's a priority that will help you sleep at night, it makes a strong consideration for being worthwhile. Now, this decision might also align with helping to preserve your investments to either leave a larger legacy to charity and family someday, or for other reasons if that's important to you. Some people will buy it to help ensure there are enough investments available for a relatively healthy spouse that doesn't need long-term care support at the same time. In this case, there are insurance companies in the industry that will offer what's called a shared benefit policy, which is based on the health and the mortality risks of not one, but two spouses. And when that risk is spread out between two people, and if there is a benefit term shared between the people for a short period of time, perhaps in the range of 3 to 5 years, a long-term care insurance policy can be treated like a supplement to other forms of insurance and assets. And in this way, it's often less costly. Now, I'd like to pivot back to Grant a bit here after we review a few more financial planning related items. But clearly, as we've seen, the long-term care insurance side of things, not everyone will have the form of long-term care that we otherwise fear, and there are some considerations to be made throughout. The eighth myth here is that you should spend all of your non-IRA or non-retirement account assets first. Now, the allure here is that when you're in your working career, you're usually in a higher tax bracket because you're earning wages, especially in those peak earning years and the years leading directly up to retirement. And there's the desire to actually spend from the types of monies that will result in the least amount of tax burden possible. So instead of, pulling money from a retirement account, you spend from cash or other types of taxable investment assets that are not contained within a retirement account. So we'd like to review here what the impacts of those will be. First, when you think about the effective kind of taxable distributions, as we call them, what happens is if you drain down those non-IRA assets, well, later on, you are faced with what's called a required minimum distribution, which begins at age 72. Now, that was pushed back from age 70 back in the Budget Act, which was passed in late 2019 through something called the Secure Act, and actually bumped out that age of required distribution to age 72. But if you're draining your monies from non-IRA buckets first, and then your IRA is growing and growing and growing, you will ultimately have a forced higher required minimum distribution later on. And if you ultimately leave a nest egg to your family later on, and you have mostly IRA monies only, which are pre-tax in nature, well, now you have a burden that you have to share with your family. And also part of that Secure Act, which was passed in 2019, which became very important with IRAs, is that there's now a 10-year window for your heirs that they're forced to take money out within just 10 years after your death, whereas before they could carry out the same balance over their lifetime. So it ends up being a larger tax burden in that regard as well. And really, it offers just a lack of flexibility. The government changes rules somewhat frequently around how to tax different sources of income, capital gain income from taxable accounts, and ordinary income from IRA assets or annuities or pensions and Social Security or those kinds of things. And if you have just one bucket left over, it obviously provides for a whole lot less flexibility. Now, we'd like to illustrate an example here because I think this puts a little bit more numbers in front of this, so it's not such a decision point based on all of our discussions here. So take an example of John and Jane, age 68, have a $1 million investable asset portfolio, of which $600,000 is in an IRA and $400,000 is in a non-IRA or a taxable account balance. They also receive Social Security benefits. And in total, when you think about their annual living expenses of $65,000, will have an income need off their portfolio. Now, this is, again, a fairly robust spreadsheet, but to illustrate the point, when you think about John and Jane needing monies from their investment portfolio, on the left-hand side, we have their ages and the years. And what's illustrated here is a taxable account withdrawal, or the monies they will need to actually pull from their investments. And then there's a column for the required minimum distribution. And then there's a column for tax bracket. And on the right-hand side is a second illustration, which I'll review here in just a moment. But you can see if they take from their taxable investment accounts, well, the upside is that under current tax environment, their bracket would remain at a 10% tax bracket level, which is very, very friendly. And actually, when your regular income is taxed at 10%, your capital gain income is not taxable at all. So it is a very friendly time period for John and Jane to be retired here before age 72. But then the IRA continues to grow in balance. And at age 72, there is actually a forecasted required distribution of about $100,000 per year. And each year, the government looks at the market value of your IRA, it divides it by your life expectancy, and that's ultimately what comes up with that required distribution figure. And you can see that their tax bracket jumps from 10% to 22%, and then to 25%. And then by about 2036, they're in the 28% bracket for the rest of their lives. And that required distribution only grows and grows and grows. Now, if you change the logic a bit and instead focus less on minimizing tax now and instead think about minimizing taxes over a lifetime, we talk a lot about blending someone's tax rates to minimize their lifetime income tax bill. So, emphasizing maybe some withdrawals out of an IRA today to help limit what has to come out of a taxable account or an IRA later is exactly what's illustrated. So the required distribution ends up being a whole lot less when they have to start taking funds out at 72 and remains fairly steady during this time period. Their tax bracket also doesn't hit that 28% bracket until about 6 years later than the first example. So when you put all of that in perspective, you start asking the question of, well, how much taxes did this really save over time? So to compare the two, just a change of withdrawal strategy, not using the taxable bucket only, but instead using the IRA at the beginning of life, and not considering anything of what's called a Roth conversion, which is a different decision to actually put more money into a tax-free bucket. You can see a comparison of the two outlines what's called a date of death or a DOD balance after taxes. So this is a forecasted value of all of their investment accounts growing over time, and then imposing the particular taxes that would be due on the IRA at the end of someone's life. And the differences between these two, the second, of course, being the one where prioritized IRA withdrawals early in retirement, actually added about $61,000 of total additional assets over their lifetime because of reduced taxes. That's a pretty significant benefit just by switching the ordering of how you take funds out of different buckets. And when we think about what that means for us, that's real spendable dollars. $61,000 over a lifetime of saved income taxes can be significant for charitable reasons or for family reasons or frankly for enhancing someone's lifestyle. But clearly a 4% enhancement in lifestyle makes a significant difference long term. Now, when we're talking about kind of passing on assets and accounts at someone's date of death, I'm going to pivot back to Grant to talk further about estate planning.
So the next myth that we want to talk about is the idea that estate planning is only for the rich. A lot of times, especially now with the estate exemption amount at $11.7 million per person, people often think that because they don't have to pay an estate tax, that they don't need to worry about their estate plan, which in this case is false. Really, estate planning protects the living. It's not so much for the person that passed away. It's for either for them while they're alive through powers of attorney or for their heirs. So powers of attorney for healthcare and property are very important documents that allows for someone that you predetermine to step in and make healthcare or property financial decisions on your behalf. The next document that's also important is a living will. This provides medical directives for if you want to continue with life-sustaining measures or not. So ultimately, the power of attorney for healthcare would have final say, but this is just a way for each individual person to have their wishes documented and to not really put all of that burden on someone else to make that decision. Guardianship is often overlooked. If individuals in their 20s, 30s, and 40s with small kids at home often don't have the financial resources to feel that it's worthwhile to have an estate plan, even a simple will. But guardianship is an enormous decision. So within the will itself, who would take care of your kids in the event that you pass away before they turn 18? And lastly, trusts for beneficiaries are also an important piece of estate planning. So in terms of trust, they help in a variety of ways. First and foremost, trust can serve a purpose to help a surviving spouse with money management. It can provide a monthly or annual income stream for that spouse The trustee also would have the ability to reach in for medical expenses, support, maintenance, and other predetermined reasons for accessing the trust assets to kind of pay any expenses that are needed. The trust will also protect young beneficiaries. So if we look at folks that have retirement assets, after-tax investment assets, life insurance being an often overlooked component, if you do not have a trust in place, the default is when that child turns 18, they have free access to that money without any strings attached. A lot of times the trust can be beneficial by allowing the trustee to reach into that account again for medical expenses, for education needs, possibly a down payment on a first house, as well as an income stream for those beneficiaries, but also providing the ability to delay distributions of the principal of the trust assets to some predetermined ages. So for example, you could have someone receive a third of the assets at age 30, a third at 35, and the last third at age 40. The benefit there is it's forcing a beneficiary to really pave their own way, to establish a career, get educated, so that they're not just relying on trust assets when they turn 18. Trusts also ensure assets flow through the bloodline or to the intended recipients. So for example, if someone did not have a trust and they left all their assets to a surviving spouse, theoretically that surviving spouse may remarry down the line, and then those assets could actually make their way to a different family. So the trust itself provides that continuity plan to ensure that the assets would remain in the bloodline. And lastly, to make sure family heirlooms are distributed to the appropriate beneficiaries. If there's a classic car or an antique furniture piece or an engagement ring, some of these things that have more sentimental value, you can document within the estate documents themselves who receives those assets, so that it goes according to your wishes and also hopefully results in less bickering between family members. And our last myth here today is that guaranteed investments are risk-free. This really centers around annuities. You may not have heard them as much lately, but I can almost guarantee you the next market downturn, virtually every other commercial will be an annuity commercial on the TV. And so we want to talk about annuities from a high level to see, are the guarantees really risk-free? Are they worth it? So what they ultimately promise, and again, you probably have heard these commercials, that you can participate when the market goes up, but you won't lose money when the market goes down. There's oftentimes under the hood a 3% kind of guaranteed rate of return. And really, if something's too good to be true, then it often is. And so we want to talk here in the next couple slides about some of those details. First, it's important to understand the policy structure. So these are what are called equity indexed annuities. There's a few different components to these contracts. The first is the calculation method. So there's a point-to-point calculation. If you took out the policy today on August 25th, the calculation would not take into account what happens over the next 12 months. It will only look at August 25th of next year. That's point to point, and it will say, did that market, did that index go up in value or down in value, and by how much? The other piece that's important to understand is that that is purely the growth component. So in these annuities, you do not participate in the dividends that are paid out. So it's a way that they can kind of reduce the return in essence. The dividends are just absorbed by that insurance company. They receive that benefit. It is only looking at any point movement, positive or negative. Let's say that during a 12-month window, the S&P 500 was up 10%. That would be the first calculation method, a 10% number. The next piece, though, looks at a participation rate. So because their promise is that you will participate when the market's up, not fully participate, but that you have protection when the market's down, they're not going to give you all that return. So the participation rate typically is about 75%. So again, if the S&P made 10% over that 12-month period of time, you only participate 75%. So your return would be 7.5% in that illustration. The last piece, though, is that these annuity companies provide annual caps. So they basically dictate the maximum benefit that you can have in any given calendar year or annuity contract year. So a typical cap may be 6%. So again, in my example before, a 10% S&P 500 return, you participate 75%, so it brings it down to 7.5%, but that is still above what the cap is for that year at 6%, so then you would only receive 6% return for that hypothetical example. Some of the challenges of these annuities, first off, it is a single company investment. So you are giving your money to one insurance company. As we saw in 2008 with AIG, among others, insurance companies, when challenged, may not be able to fulfill their promises. The second piece is annuities are very difficult to understand. It's, in my opinion, done intentionally. If you've ever read the 150-page prospectus, it will be very confusing, a lot of legal definitions in there. And again, things just like what we talked about with participation rates and caps that most investors don't understand when they're going into that product. The next part is, as we said before, no dividend credit, which on average, dividends are about 2% a year. So that's return that you do not participate in. Only one index typically to track. As Jake alluded to earlier in the presentation, when we look over time at diversified portfolios, they tend to perform better than any one standalone index. The S&P 500 or US large cap stocks tend to be the index that's focused on for these annuity companies. And lastly, the surrender fees. Most of the time, if you make an investment, you can change your mind. So 6 months later, you can sell out of a specific stock or fund, and generally speaking, there isn't much of a penalty. Because annuities are, quite frankly, the highest commission generating product out there, the broker that sold that contract is paid a significant sum up front, and the insurance company needs to make sure that they're going to make that money back over a period of time. So if someone cancels or surrenders an annuity in the first 10 to even 15 years, they have to pay a penalty. That penalty can be as high as 15%. So this is something that if you sign on the dotted line, a year from now, you decide that this is not what you thought it was, you're going to have to pay a pretty significant sum just to get out of that contract. And ultimately, the question is, how strong is the guarantee? Because if you look at the participation rate, you back out the dividends, you look at the caps, generally speaking, you're looking at about a 3% annual guaranteed rate of return through the insurance company. However, it is subject to surrender fees as well. If we look and compare to just normal stock returns, going back to 1926, for any 15-year holding period for the US large cap stock market, 4.4% of the time, there was less than a 3% rate of return. So in other words, 95.6% of the time, you are better off than that annuity guarantee by being invested in US large cap stocks. 0.2% of the time, there was a negative return. And ultimately, the average over that period of time was 10.6%. Now, granted, there is volatility anytime you invest in stocks, but you are compensated for that risk. And this shows if you have a longer holding period, the true volatility risk is quite a bit less when comparing it to some of these annuity contracts. And if we look at a little bit more current data starting in 1973 through 2020, we actually did not have a single 15-year rolling period that resulted in less than a 3% rate of return. So at the end of the day, again, in my opinion, if you're looking at some of these equity indexed annuities, you're almost always better off having the funds yourself, investing it so that you have the ability to take money out whenever you want. And really, if you're concerned about the risk, that's the important piece of bonds. You can use that to kind of dial down the risk factor, which should smooth some of the bounciness or volatility that you experience over, in this case, a 15-year time horizon.
Well, thanks, Grant, for going through those last few sections there. And at this point, we'd like to kind of pivot to the question and answer section where we've had some questions come in throughout today's presentation. Grant, one for you just off the bat here, in terms of incorporating cryptocurrencies in an investor portfolio, whether it's just an investor portfolio in general or from a Savant perspective. Be curious for your thoughts on that.
Yep. So cryptocurrency has obviously been kind of all the rage here the last few years. At its core, though, cryptocurrency is a very volatile, speculative asset. So the reason that Bitcoin, for example, is worth $50,000 per coin really has no difference than it being worth $20,000. It's just what the market determines is a fair price. So unlike stocks that have company earnings, dividend payouts, cash flow that you can kind of back in to determine what the true value is, cryptocurrency essentially is in my opinion, again, a different form of gambling. There's nothing that says that Bitcoin should be worth $1,000 versus $100,000. I certainly understand the concern that if there's a limited amount of supply of these cryptocurrencies compared to, let's say, the U.S. Federal debt at $29 trillion, certainly borrowing money and printing money longer term will devalue the dollar. So there's some advantage to other assets that may help in that circumstance. But I think cryptocurrency, it's kind of like a spice in a meal. A little bit goes a long way. So if you are going to invest, I would do a very modest amount in cryptocurrency, knowing that it's really speculative, another form of gambling, and let the core portfolio be tried and true without significant volatility like cryptocurrency has experienced.
Yeah, I agree. I mean, I think anytime it comes down to speculation a bit, right, a concentration of wealth, and of course, there's the chance you can get really rich if you can sell it to somebody, or obviously the risk of getting really poor would hold true for that, just as with any other concentrated asset class. There's a question here about if considering retirement here this year or in the relatively near future, thinking about those annuities and going back to some of the comments you had before, Grant, the risk of return mitigation strategy, given where we're at with elevated market valuations, whether that makes sense at all. Now, from my perspective, where we are at today, it's easy to hear the news and hear about record highs and all-time highs as we continue to experience them. But you kind of have to remember that there's some context to be added to that. We're actually experiencing a record high about one time every 9 or 10 trading days. So roughly 10 to 11% of the time, we're always hitting market highs. And we easily could look back with the benefit of hindsight 5 or 10 years from now and say, boy, an annuity made a lot of sense because we went through a very weak period in stocks. And frankly, maybe there were some really significant bear markets considered in this as well. But, over the long run, when we know, to Grant's point that he made earlier in the presentation, that there haven't really been many 15-year time periods, or frankly, even 10-year time periods where a return in overall stocks and bonds wouldn't have exceeded whatever a guarantee is within an annuity contract, it'd be hard pressed to concentrate a lot of wealth in just one type of product. So if you're going to give consideration to annuities, you have to be very careful to consider all, obviously, the benefits, the features, the risks, and the costs. And then relative to your entire net worth, be careful with how much you'd consider putting into a product like that. Grant, there's another question here about assets that pass on to the next generation. So if someone has either this revocable living trust or a testamentary trust, for example, but they also have IRAs, and the IRAs are maybe payable to a trust, there's a question about whether heirs would have to pay taxes on those IRAs that ultimately get passed through those conduit vehicles.
And the quick answer is yes. So IRA withdrawals, anytime, whether it's the individual that owns the IRA or established the IRA, or the inherited children, let's say, that inherit those IRA dollars, the next generation now has, because of the Secure Act, 10 years where they have to fully withdraw the IRA. It can be all year 1, all year 10, or evenly throughout. But anytime those beneficiaries are taking withdrawals from IRA accounts, whether passed directly by beneficiary designation or via a trust, they do have to report the withdrawals as income on their tax return and pay tax on those dollars in the year in which they are taken out. So unfortunately, the trust vehicle itself is a good way to pass along assets and potentially have some strings attached to them, but it does not really have any impact on the taxation that of IRA withdrawals that future beneficiaries would have.
Yeah, that's great. And this is a similar question with respect to kind of blending withdrawals from different kinds of accounts. The question being, how does that get figured out, and does the strategy adjust over time? Yeah, clearly, from Savant's perspective, we use different tools, and advisors generally do, to figure out how best to take out from different types of accounts. And while we want to focus on someone's lifetime tax bill, you also have to realize that the rules you have to play by are the ones that are enforced today. And of course, the game of trying to figure out what the rules will be next year or even the year after that sometimes can be quite complicated. And so you put together a plan, just like with any longer term financial plan, knowing that the day you make the plan, it's probably going to be incorrect, but at least directionally we're moving the right way. And that's no different here. So every year it works out to make sure that you're taking advantage of whatever the current tax bracket that you're in, or perhaps going into another higher tax bracket if it makes sense, based upon what goals you might have for your own personal wealth, or frankly, for what leaving a legacy might look like later on. So it becomes a very unique and individualized decision process, but you have to blend both the longer term expectations and the benefits of a blended withdrawal strategy, or adding Roth conversions to that, and then how it actually applies on a year in, year out basis is one that it gets applied very, very uniquely. And that's all the time we have today for questions, but we certainly want to thank you for participating in today's webinar. And as a reminder from before, a survey will actually pop up in your web browser after the webinar ends. So if you have any specific questions that were not answered during our Q&A session here, be sure to put them in the survey under questions and comments, and we will gladly follow up. And of course, at any time, if you're looking for more information about Savant, we'd like to invite you to go to our website, savantwealth.com, to learn more. And thank you again so much for joining us. Have a great day.